Greetings, everybody. This is Jeff Scott, and welcome to this week's rendition of my top-down review. It is August 30th, 2015. It is approximately 7 p.m. When I look at my futures, it shows that we're down close to, well, we're off the lows, 150 on the Dow. S&P is down 21 and the NASDAQ's down 42. So about 1% across the board, and Russell a little bit less so. So still early in the Sunday eve, and probably before we'll see much in the way of changes or of additional information at least. I titled today From Flash Crash Back to Resistance. Wow, that was crazy, wasn't it? On Monday last week and Tuesday, surprisingly finished up for many of us to be a very strong week. Looks like based upon the futures that we're starting out with volatility this week already. I said this last week, time will tell if we've entered a bear, and your number one job is to protect your nest egg and live to fight again. I say that with experience of coming through the 2000 bear without a whole lot of cash left to put in the market. Fortunately, I was early in my career making money as a physician and with my healthcare businesses that I was able to fight again, and I made sure that the 2008 bear, I was able to fight again when that ended. Disclaimer, this for education purposes only. Anything I recommend is in the spirit of education, not investment advice. I'm a doctor, not a broker. I'm truly independent. Nobody pays me to say good things about their product or bad things about a competitor, and I've paid for everything that I demonstrate. Trading involves risk, and you alone are solely responsible for any investment decisions you make. I always start with this slide but since we're going to have a lot to talk about today, let me just say basically I'm schooled in a can-slim basis. I've learned from John Person how to actually take the trade and manage it, and I've used these other folks to help me understand when to trade, when not to trade, how to manage my position sizing, etc. These are all important influences to me, and when I do education, I try to teach you to be your own guru. I'm not a guru, is what I learned from Ian Woodward, and I would say the same thing. I want to teach you through using your own tools and reading to be your own guru. I have a lot of programs. I hide my desktop on purpose, but what I really need is something to trade with. TradeStation and Thinkorswim usually are my two. I'll tell you, last week Thinkorswim was a problem on Monday and Tuesday. Getting it to even start up and then getting it to take a trade. Even the week before, I ended up trying to sell something. Could never tell if I sold it. I ended up going short because I sold it twice. It was a good thing to be short going into Monday, though, so I can't complain too much. Genesis is a very featured platform, but it's expensive and not supplied by any brokers. I use HGSI and EdgeRater for the majority of my post-market analysis. Seasonality is important to me, and I have a number of websites I like. I'm referring to Monday morning as the Monday morning massacre. And what I tried to do was look at the drop at the open by a large number of stocks, both in percentages and in points. And the way I came up with this is I said, all right, if you bought stocks at the close on Friday of the 23rd and sold them on, well, Friday the 20th, it must have been the 21st. If you bought them at 4 o'clock on Friday the 21st and you sold them at 4 o'clock on Friday the 28th, that would tell me what your performance was from last week's close. If, on the other hand, you bought them at the open on Monday, that would tell me the difference, the performance from Monday's open. The difference between the two would have been how much you dropped or before the open on Monday or at the open on Monday. And as we all know, the drop was significant. There are many ways of looking at it. Whether this was another flash crash, whether it was all margin calls, I just took the the NASDAQ 100, Anadarko fell 14%, Ford 13%, Celgene 13%, Facebook 12%, Apple 12%. And then you look at how many points that was. It was just massive. Now, one thing I learned from John Person and he reiterated it to his trading room before the market opened on Monday, was to go out and put orders in to sell your shorts and to take long positions at ridiculous prices that if you got filled, it'd be sort of a miracle and a big win, but you wouldn't expect to be filled. And lo and behold, I got filled at low prices on Netflix and Apple, and I got rid of my Tesla short at 197, so I was a happy camper. By the time we got to Friday, as most people know, the markets had reversed nicely. Friday was a mixed day. It did go up towards the end of the day, and you could see that strength was in energy. Here's Energy XLE, the XOP, and the OIH, and they're all green throughout. XLF financials, at least for the big banks, credit cards were red. There was some strength in regional banks. Other things that stood out to me, technology has a lot of green, especially semiconductors. Utilities, mostly red. And healthcare, when you start to look at biotech, also perked up at the end of the week. I think the major markets tell a story. There's a couple of stories here. First thing to see is it's hard to say you're in a very bullish market condition when your E-minis, your NASDAQ 100, your Dow futures, and your Russell futures are all trading well below the 200-day moving average in red. We also have had a death cross in the E-minis, a death cross in the NASDAQ, and about to have a death cross of the 50 crossing below the 200 in the Russell futures. So if you want to be bearish, you have plenty of reasons to be bearish. You had the big spike in the VIX, and it sounds like if the market opened right now, we might even go up even higher. We'll talk more about the VIX later. And the dollar pulled back to the 200-day moving average. It's now sort of in a range between the 200 and the 50. If we look at all the indexes, you'll see a similar thing, which is just a gigantic dump on Monday. Tuesday was an indecision day, although it did trade up. It came back to where it opened. And then Wednesday and Thursday were big bullish days, and Friday closing sort of an inside day for the most part, closing at the upper ranges until the end when it moved up. So short term, obviously Wednesday, Thursday were very bullish days, but the market still is in a challenging position. Now, we did have buy signals on Genesis, which is these are persons buys on the E-minis, the NQs, the TFs, the YMs, and the NYSC at the end of the day on Friday. And notice these huge hammers on the weekly charts. So if someone has to push me, to shove me, to ask me, am I going long or short this week? Obviously I'll let the market tell me what I'm going to do, and the futures look kind of ugly right now. When I see candles like this, I want to be going long. So I'm hoping that the futures will turn around and give us some uptime going into Labor Day, maybe somewhat of a summer rally. Those are major hammers on the major indexes. But I also remember that September lurks. And whether I'm looking at the S&P, where September is its largest down month over time, losing an average of 1%, with an occasional big hit, minus 14% in September in 98, for example. It's an average of flat on the NASDAQ and down a little bit less than 1% on the Dow Jones. September is a challenging month, and often people say it's one of the toughest months of the year. Now, interest rates rose this week. They got back above support, closing a little bit less than 2.2%. And as I said before, rising rates are good for banks, especially regionals and insurers. Falling rates are good for people that pay a dividend or require financing, such as REITs, MLPs, utilities, and home builders. So one thing that I've sort of gleaned from the market over the last couple of years is whenever this market is dropping a rate below 2%, it's not really doing it because the market wants to be more accommodating. It's usually doing it because it's in fear of a failure of the economy. And one thing we did see this year is that this past week is that GDP is humming around well over 3%. My Lowry research tools, the buying and selling power coming back towards the mean, reversion to the mean there is a good sign. The market can go up while the buying power is rising off of a low and the selling power is dropping. But it'd be nice to see the selling pressure underneath the buying power. The AD lines improved a little bit this week, but they're still clearly pointing down. Here's the AD lines using Warden, and you could see if this was a stock, we crossed below the 50-day moving average on the, I believe this is on the weekly, and actually moved up a little bit this week on the AD line. Here's the daily AD line, also rolling over. This would be on the NYSE. Also, narrowed participation improved. You could see on the daily that we bounced off the bottom. Now notice that the daily of stocks above the 200 SMA dropped below the levels seen in 2014. In fact, it dropped to levels very much similar to 2011 and before. Here are stocks above the 40 on a weekly view, and you can see we dropped down to about 5%, which was equal to what we did in the end of 2011. There's a lot of things about this market correction that remind me of 2011. Canaries in the coal mine perhaps really depict better than anybody else or anything else what we saw in the market. And what you saw was they dropped hard, and on Monday actually dropped below their 200-day moving average. They retook the 50-day MA. They had a 12% drop from the highs, or 23% drop off the highs, and they've retaken the 50. That would give me a little bit of bullish sentiment. Let me educate you of a couple of things that we've not talked about necessarily before. William O'Neill talks about follow-through days for the bulls. In HGSI, we have follow-through days for the bulls and the bears. For the bears, a follow-through day is the phoenix. When I start to see the phoenix, it tells me that this market is having exuberance to the downside. After a bingo, which is sort of the baby's out with the bathwater, that third phoenix in a row may have been signaling to us that this market is getting oversold. And perhaps we should not have been surprised for the bounce that we saw. Now these two green things here, they're two together, are called the eurekas. And both the phoenixes and the eurekas are calculated on the NYSE or the NASDAQ. They're not calculated on an individual stock. And those eurekas forming after a bingo is sort of the all clear signal that I often look to after a sell-off. Another notch in the bullish category. So market thoughts, we had a bounce after a flash crash like beginning of the week. The bounce was oppressive, but it's V-shaped, so higher risk of failure. Concern that the prior support, in this case the 200-day moving average, which is getting very close on the NASDAQ, not too far away on the Dow, ways to go on the ES and the Russell, that 200-day moving average may turn out to be resistance. In fact, last week I titled my review, "When Support Turns to Resistant, Danger Often Follows." You know, Fed will be in the spotlight this week with the Beige Book out, monthly unemployment report, and then we wonder what the next shoe to drop is. China, Greece, auto debt, education debt. Maybe the cover of Barron's, which was relatively bullish, will spook the market. Who knows? Longer term, I still think we're in topping action. We have to deal with the slowing worldwide economy versus full employment in the U.S., putting the Fed in a hot seat. Feels like October 2011. I want to go back and look at that today. Corrections do not mean we're in a bear, and risk management is prudent. I show this all the time. Why? Because we went through this period on the right here, and you have to manage your portfolio different here. And I probably, and I know others that have told me the same thing, made more money this past week than they've made in the prior 4 months or 5 months. What did I do? And the week ending August 23rd, I sold my laggards. I've been selling laggards for a while to raise cash. I did a number of things to protect my portfolio, buying puts on long-term holdings, insuring my portfolio with OEX put spreads, and then playing for the downside with some Q puts, SDS calls, TZA calls, VXX calls, and BIS calls. And then there was a little bit of offensive move with shorts or puts, and I had a short on United Airlines, which I barely covered at a win before it got added to the S&P and went up, and then puts on Tesla, Ryder Trucks, Jazz, among others. So I felt pretty good on Friday a week ago that I was well placed for anything that the market could throw at me. A few comments about stops. I've learned through hard knocks that when I see the market's going to open up 200 or 300 points, that my stops will get me taken out at the low trade of the day. I take my stops off prior if I see the market's going to tank. Risky endeavor, not for everybody. I've just learned that why sell at the low of the day when I could try and get some of that back. But what's better for me than stops, especially in volatile markets, is I do some married puts on my long-term holdings. So I've got a lot of holdings, but many of them have puts. What that means is I'm paying insurance. I'm usually selling an out-of-the-money call and a deep-in-the-money put as insurance. And or deep out-of-the-money put rather, if the stock trades down, unless it takes out my deeper out-of-the-money put, I can sell my put dollar for dollar if I buy it at the money put for each dollar that the stock drops. So gaps down, news days, event-driven things, they don't hurt me. Now, if I'm smart, I start to peel those puts off when the market bounces, and I can make money both on my stock as well as on the put. I'm not always that smart. Some of these puts I have purely as insurance, and I leave them. I did close out most of my bearish positions, although, as it says on 8/24, I covered my shorts at the open. I was challenged, as everybody else was, by platform issues. I sold my OEX put spreads. I wish I didn't have a spread, just a plain put, because I was deep in the money. I sold half my contra ETFs at the open and scaled down the remainder slowly over the next 2 days. And then I also, at the urging of John Person in his room, placed buy orders on stocks I want to own much cheaper. Apple, Netflix, SCMP, and I got some pretty wicked fills. As we go into this week, it's important to know your news and earnings dates. Not much in the way of earnings, but there's some big names. There is Ambarilla, widely held name. There is Qihu, one of these Chinese stocks where the CEO said, I'll take it public or take it private because then he could list it on the Chinese market, which was going crazy. And now what a big surprise. They came back and said they may change their mind or reprice it lower because of market conditions. Zoomies, Vince, some retail left. But all in all, a relatively quiet week. 5 below was a nice looking, well, not a nice looking chart, but I thought an interesting story as well. On the news, there's a lot of different things here. I think the big movers are going to be the federal beige book and the unemployment claims for Friday. Chart of the week. As I said, these are for educational purposes only. I did put on the board Monday night that I took my buy off, that even if the market bounced, I wasn't going to play it, at least with the chart of the week. I thought much of the big wins were already done with what I was able to do at the open on Monday. Obviously, Wednesday and Thursday proved me wrong. There was an opportunity, but I don't want people taking trades that are high risk. I did pick something for this week, TTPH. TTPH is a biotech stock. You know, the IBB got hammered. The reason why I like this stock is if I put it on a monthly, it's harder to see here. It was in a very nice, steep monthly uptrend. It's pulled back to support. You could see on Monday it had this crazy day on the 200 with a huge bottoming tail. Stayed on the 200 Tuesday, moved up Wednesday and Thursday, but more importantly, Friday it broke out with mostly green above. A mobile breakout out of the squeeze. It had a PSA reversal out of the squeeze, a pocket pivot, and a kahuna. If this market goes up, I expect TTPH. Now, what I don't like about TTPH is I'd rather be buying it at the 200, excuse me, at the 50. It's already had a bit of a move, so my stop placement might be a little bit trickier, but this is a stock that looks like it wants to go higher. So other reasons why I wanted to buy it, it had a PPS buy, and John, this is a daily chart, a high closed doji. Certainly is a pullback. As I said, it's in an uptrend. These are my indicators down here where green is good. Yellow means it's in a squeeze. So my buy stop will be somewhere between the closing price, which was about 44, and the high of the day, which was 44.48. To be safe, I might put a buy stop at 44.50. My target will be resistance 1, which is at 52. My stop will be at the low of the doji day, which is 39.35. Still risking 5%, which is 11%, which is more than I felt comfortable with. My thoughts as I looked at charts this week, there wasn't the perfect chart. Yes, Diamond Offshore looks fantastic, as does FCN and a number of oil services stocks. Alcoa, I bought some on Friday. It looks great coming off the bottom. I have a coal play that pays a 10 or 15% dividend. Take a look at Arch Coal. It's driving coal off the bottom as Icon is getting interested in coal. But these were all bottom fishing, and I'm looking for stocks that have pulled back in an uptrend that I think have a higher likelihood of going up. So as always, we'll look at the market, top-down analysis, some bottoms-up work. We've done our chart of the week, and then we'll go forward. Again, reminding everybody live events. I'll be at the George Mills Orange County meeting October 16th through 18th in Santa Ana, California by John Wayne Airport at the lovely Santa Ana Holiday Inn. Excuse me. I will not be at the PV meeting. I highly recommend it, though, with Ron and Ian. If you've not been there, you need to go. If you've been there before, you know what I'm saying. You need to go back. Ian will be there. And then I will be speaking close to home at the Palm Beach Gardens meeting at John Person, October 31st to November 2nd. All right, so let's start by looking at my Excel spreadsheet. Who would have thought, as we were sitting there Monday morning, that my postscript of the week would be that mostly black. So some red, but mostly black. So most of my watch lists were up on the week. The S&P 500 up about 1%. The HGS 100 up about a third. The IBD 50 up 1.5%. I mean, the IBD 50 is a narrower list. Easier to move it. Big amounts up or down. But what was interesting to me is my holdings were up 3% if I had held on to them. 2 to 1 positive to negative. And the ones that I'm looking at buying, although it was sort of neutral, positive to negative, I had some winners that would have been up 4.6. Now remember these numbers. 1% on the S&P, 1.5% on the IBD, and 4.6 on mine. If I look at what happens if you bought them at the open on Monday instead of the close on Friday, my stocks would have been up 11%. So that tells me that I must have dropped 6, 7, 8% at the open for me to get that high at the end of the week. So 11% recovery. Here's one group broken out and running, which I think is SCMP, or is Arch Coal rather, driven, up 195% on the week. That was in a watch list from the prior weekend. IBD 50 up 8.19. So that meant it dropped, again, 7%, give or take. HGSI 100 from Monday open up 6%. And the ones that I looked at buying from the open were up about 6% as well. So very unusual that these two lists are so different. And it really calls out the precipitous drop in the market we saw at the open. So did we see a Hindenburg? Of course not. You have to have new highs to get a Hindi, and we haven't had many new highs since August 10th. Now what is nice to see is the new lows, which were as high as 39% on Monday, have dropped down to less than 1%. Buckets, we've come off the oversold condition, but we still have 82% of stocks in the S&P 1500 below the midline on the Bollinger Band. Not many underneath the Bollinger Bands. This is what really bad looked like. This was on Monday with 70% of the stocks trading below the lower band. And no shocker that we had a nice recovery at that point. Now, part of the things you get in a recovery is you look for kahunas or a big move in percent B in the Bollinger Bands over at 0.24 across the major indexes. And we shifted the Woody indicator to green from red. Maybe this will be stopping power in the beginning of a little bit of a reprieve. Still not sold on that, so we'll see what happens. Let's skip to the seasonality part. On a seasonality perspective, if one looks at the ETFs, and let's just look at 1 month performance. And you could see that pharmaceuticals up 3%, biotech up 1%, 10 out of 14 years. The losers are semiconductors, base material, technology over the next month. If you look at the month of September, for example, in the ETFs, you could see that September is overwhelmingly to the negative side. And again, technology, base materials, semiconductors versus pharmaceuticals, aerospace up top. But not much up top. Weighting is clearly towards the bottom of the percentages. From a stock perspective, there are stocks that move this time of year. This is looking at performance over the next month. And you can see a number of stocks with at least 15 out of 20 in positive years and with their return. And then over here, you could see some of the stocks with the biggest return. So Medivation up an average of 20%, 12 out of 12 years. United Airlines up 9%, 7 out of 9. Nike up 7%, 17 out of 20. Just a couple that stood out. Patterson Company up 6%, 17 out of 20 years. So there are some seasonality things you can look at this week as well. Now let's jump into TradeStation just to look at my person indicators and my elder on the major indexes. So remember, futures are trading, so that means the last bar on the future is today. So let's start with the E-minis. Currently, they are 21 points below fair market value, and you could see they're blue. Now the blue is a color from elder. Red is you should be shorting or holding. Green, it's okay to be long or holding. Blue, basically, you can do whatever you want. And the story we're going to see is a lot of blue on the daily, but red on the weekly and monthly. So on a longer term frame, we're in a sell signal. We're neutral on the elder, but we're on a buy here on John's indicators. That's the E-minis. The NASDAQ 100 futures, same story. Blue, red, although blue on the monthly, in a person buy. Russell futures, person buy, blue, red, and red, similar to the E-minis. We could look at things like the semiconductors, and you'll see strength coming in where they've actually turned green on a buy signal, and we're enough to move the weekly to blue, but still monthly in a downtrend with red. So these green dots here represent evidence of potential MACD divergence. It can go on for quite some time, but typically you get a reversion, and we saw that this past week. So looking at the indexes, I think we still have some tough work ahead of us. Not even looking at targets and moving averages and things like that, but still it is nice to see both John and Alexander Elder's indicators suggesting that we could be moving up from the perspective of the major indexes. Obviously, we got to get through the next few days. Let's take a look at sectors. XLB, which is materials, person buy, elder on a hold. XLE energy, you can see a big move off the bottom and even turn green. So you've got some buy there. You had the MACD divergence on the weekly, blue on the weekly, red on the monthly. Financials had been doing well and sold off hard, are on a person buy, although red on the weekly and monthly. Industrials, Again, person buy, red, showing some MACD divergences on the weekly, red on the monthly. XLK, look at the tech spiders, how they fell on Monday. On Monday, for example, high was 39.61, the low was 31.32, so that's 830 on a 40. That's a 20% move in a single day on the spiders. XLP staples, again on a buy signal in blue, but with red on the weekly. Utilities have come down hard. I'm still red on the weekly and monthly, and on a person sell signal, but starting to go blue on Elder. Healthcare, also a big down day on Monday. What was that percent? Probably similar. 15, 14, 13, 14, and 30 and 44. Yeah, about 20% move in a single day in healthcare as well on a buy signal. And then XLY, which must be discretionary, buy signal in blue, but still red on the later time frames. So as I look at this, I see that better. We've got a lot of buy signals, but nothing that's coming out cheerleading and saying that this is all over. Now I'll go into HGSI and go into my warehouse view, go down to Woodward and Brown groups, Major Markets Plus, rank them. Most of this is related to Friday, some on the week and some for 3 weeks. You can see over that time frame, oil has been the big mover. We'll look at that big bounce off the bottom. Gold up at the top as well. Volatility came down this week, but maybe it's going to go back up based upon the early futures. And you could see the major indexes, although they had a decent week, or a decent Friday, were down on the week for the last 5 days. So let's look at the S&P 500 for a while. So first thing I want to do is remind everybody what some of these lines are. My purple is an 8-day exponential. The green, the blue, and the red are respectively a 17, 50, and a 200-day simple moving average. These red dots and green dots are part of Wells Wilder's PSAR. Down here, the blues are kahunas. Blue is good, meaning a kahuna to the upside. Red and pink, kahuna to the downside. There are no pocket pivots because there are no volume. Up here are squeezes and mobile breakouts. Bible gap ups, which you won't see on this index. Force, which you won't see because of volume, accumulation, distribution, and bongos. This is a bingo, which is babies out with the bathwater. This maroon is the Phoenix. The green is the Eureka. So as I look at the S&P, I see that on Wednesday it had Phoenixes, Eurekas and Kahunas, which could be evidence that this market has turned around. Let's get out of this view and let's get into a very simple moving average view, that the only thing it has is the bongo, which is sort of one of the things I was involved in developing a long-term timing model. And then the next two lines are both Hindenburg's using a little different source of the data. I've had some confusion about, are we not seeing Hindis because we're not seeing them? Or is it because we changed data provider? So I've kept the old and the new here. Let's tighten this up a little bit. And let's go and compare it. Let's go back to October 2014. So as we start here, let's draw some things. If I go from what's probably the high up here, and among friends, I'll just put it down here, down about 12.4% on the weekly on the S&P 500 from the most recent highs. I could pick which high to take. Maybe this was the high and bring it down here. And I'm down 12.4%. So, or is this the high? and I'm down 11.8%. So whatever it is, we are down about 12% on this move. So 12% from top to bottom. And that is the August 2015. This was 2014. It started in September, and from top to bottom, we had about 10% in 17 days. Now, if we look at these two, this was a V bottom. We came down gradually, not gradually, pretty hard to the 200, and then a big drop with a hammer on the day of the market. The next day, sort of a spinning bottom, I'll call it. Then a gap up on the third day, and the market was running. If I bring in my other view, you notice we saw a phoenix as we went into the final blow-off bottom of this market. And then what did we see that told us it was all clear? We saw some eurekas. So looking at this, we've already much deeper than the 2014, but it does look like we're trying a V bottom. All right, let's keep going. All right. 2012, not as much or deep as a correction. We were corrected about 8.8 here. V bottom went right back up. April 2012. About 10%. So in 2012, we had two pullbacks, both in the neighborhood of the 200-day moving average, both getting back above it within a couple of days, and pretty much a nice turnaround. Here looks like an inverse head and shoulder, shoulder, head, and then shoulder. Draw the line here. You broke above it. You broke out. Let's keep going. We're getting to the one that I think is most, I won't say concerning, but most perhaps similar to what we just went through. Let's look at 2011. So one of the things that I thought about 2011 was sort of similar. We're in a bit of a trading range here for some period of time on the S&P. That when we broke down, we'd already come down quite a way from the peak in 2011 to the first bottom in 2011 was a 20% pullback. All right. Now, when I looked at this before, actually, let me make a change in that. I basically said, let me make this, that I thought this looked like Monday. From the high was 12.4% on 66 days. I think the other was 12.8 on 67. And I wanted to understand and think back to 2011. How did the market do after the drop, and how long did it take to retake these highs? So the next day was sort of the doji day, just like ours. Then in 2011, we basically went into another trading range. Until we broke out here and broke above the 50. But you notice how you had your death cross here. You still had to go over a month before the price broke up above that 50. We failed at the 200 here, pulled back down. Ultimately, we had the golden cross in February. So we went from August to February. That what looked like a 12% correction ultimately became a 22% correction. And it took me, took you, took all of us to get back to where we were before we corrected about 87 trading days, which is about 4 months. So we didn't get out of this mess until February of 2012. Now, obviously, we kept on going, but I wanted to look back towards the same area that I put this trading range. So, is this what we should expect? I was expecting this, to be honest. I'm not expecting a V. We will see. Which tells me I've got to be concerned that we come back and either double bottom or retest our prior lows. If I go back one prior correction, could look at the 2010 correction, and the 2010 correction, top to bottom, was about 17%. But we failed several times at the 200, and it took us from the beginning of the correction to the breaking out above that was 135 trading days. And from this low we put in here after the first couple of months to get back up here was another 88 trading days. So I think that we've developed perhaps a bit of a nihilism over the last couple of years, and that this is not what all corrections look like, that sometimes we're going to get one that looks like this. And when I first, this was the 2011, and when I first saw this week, I was glad to have a lot of puts on because my fear was that we're going to have a correction that looked like 2011. We still may. I don't want to see it get below this point. It wouldn't shock me to see us come back and test. We've already been below the 200-day moving average 1, 2, 3, 4, 5, 6, 7, 8 days, and we're going to have that death cross. So put this in your bearish category where we're overdue a more complex correction. Now, saying that does not mean I'm turned into a bear, because frankly, even after this correction, we ended up coming up to new highs. So a correction is not a bear market. So I think it's going to be interesting to see. That's the S&P. Those are my thoughts. I'd like to see where it goes. I think we're going to have big resistance getting above this 200 the first time. And I am concerned about the 50 crossing below. If I take a look at the Dow Jones Industrial Average, not much more to add here. Similar pattern forming here. We already had the death cross. Man, there's a lot of junk on this chart. And now the question is, do I retest? And we've come a long ways. You know, we pulled down here to somewhere around 15,400 and we closed at 16.6. That's a 1,200 move in a single week. That's absurd. Do we retest or do we move on to new highs? No kahunas, you notice. Interesting thing is, didn't get a kahuna on any of these. Not kahuna, rather. I mean Hindenburg. And the reason you didn't get a Hindenburg on any of these is because the markets were already fairly beaten up. You're only going to get your kahunas, go back to 2008 perhaps, or 2007. You expect to get the kahunas at a high. These are markets that were getting extended. Where we're living down here, we're long beyond that point of extension. That's the Dow. Take a look at the NASDAQ. And that was, I guess, a bear flag. here perhaps, but basically we broke down here, similar story. The Russell 2000, not a whole lot to say that I haven't shown you already. So we need to repair, we need to get back above the 200, and the jury's still out as to whether we retest and get some kind of a complex pattern, or if we continue to head straight back up. I think we're due a more complex pattern. Wednesday and Thursday, I started questioning that. The VIX. As you can see, the VIX did take up, got into the 50s. Now, on a historic perspective, we haven't been there in a while, but this is what it looked like in 2008, 2009. So it can get higher, but we took out all post-recession volatility spikes. And as George Lee once taught me, you buy, you get your pencil sharp. When it starts to fall, you buy, you go to a shorter time frame. Just something to point out, one way to play the VIX has been the VXX. The VXX is sort of quiet, but you can buy fairly cheap options, and I had hundreds of the options. A very sexy and fast way is to play the UVXY. It looks like the exact same pattern, but it's off a much bigger base, and there was a lot of movement in the UVXY this past week. I think record-setting movement. I will also point out that if I put this on a monthly, that these are sucker instruments, and they spike and then they come down. They spike and they come down. They are not investment material. They are things that you buy for very short period times of volatility. If we take a look at the dollar, hold on, let me get back to where we were. The dollar broke back above the 200. It's got some resistance here at the 50. We'll see if it can break out. Dollar was certainly showed strength this past week. Strong dollar, you'd expect gold to be in pain. Gold struggling here at the 50. Hard for me to be excited by gold. It's in a clear downtrend, hasn't really broken out of it, although it does, like the VIX, spike every once in a while and get us all excited. Silver looks a lot like gold, worse. And then what did spike was oil. Now, I don't know if this was hurricane-related spike or if something's going on here, but oil clearly turned around this week. Big spike up on Friday. Thursday, let's go on a weekly view. Looks like a reversal of the bullish engulfing pattern on the weekly on huge volume. Don't think I really expected that. I don't think the market cares what I expect. And energy certainly showed a lot of strength. Go ahead, take them. Showed strength as well. Let's take a look at industry groups. And as you know, in HGSI, we have a lot. We have 173 different groups. And if we look at F2, force up today, these are moving to the upside quickly. And you could see a big change here where we had 90 groups now moving up. That's a big move. Put this in the bullish camp. So you could see there's bullish and bearish arguments all over the place as to what to expect. No surprise with oil moving up. Position 1, 2, and 6, and 9, and 11 are all energy, and 23. Energy was all over the place, and they all have the same chart. Deep bottoms with some bottom fishing opportunity. Let's take a look at some of them. So this is ConocoPhillips. This is a very typical pattern. This gray line here is the industry group, and you could see it bottom with the price of oil. A kahuna on Thursday right below the PSAR dot. Looks like this one wants to run. It pays a huge 6.3% dividend. I'm not kidding. That's a huge dividend right now for a company that, if you compare the last 2 quarters, they actually raised their dividend from 73 cents. Not going anywhere. The problem is, how much more does this go down before it starts to go up? And is this it? I don't know that this is it. This is what a bottom looked like. This might be the beginning of a bottom, but it's early, but it does pay a huge dividend. It did have a reversal day and a kahuna, ConocoPhillips. PXD, Pioneer Natural, similar pattern. The one I'm playing is Marathon. Again, similar pattern, pays a 5% dividend. Showed up on some of John's scans, and John was talking about it in his room. Anadarko Pete, a little bit more expensive stock, failed at the 17-day, same pattern. So it makes sense to me as we sort these things out that you probably ought to have some exposure in oil exploration, especially at this price. Services, I've got a couple in here. Cameron is now being taken over by Schlumberger, so it's probably a little late to play it. Really no signal the day before that anything was happening. Volume was taken off by that time, so maybe somebody knew something, but really nothing that would have alerted me. Schlumberger is the acquirer, and like the O&P, we got a V-shaped bottom here, up 2 days after sort of this reversal candle here. It had a kahuna on Thursday, still red, still in a downtrend, but had a nice move off the bottom, makes money, but lowering growth rates. Here's Halliburton, similar pattern. And there's so many here that look the same that I was interested in. FMC, this almost was my chart of the week. Multiple kahunas in a row. When I see 3 kahunas in a row, I pay attention. That's a lot of momentum coming out of the squeeze. Like this a lot, doesn't pay a dividend. I'm just bothered putting it out there as a chart of the week because it's in a downtrend. But it makes money. I think it's a nice looking chart. Diamond Offshore, let's find that one. A little bit more of a bottom, sort of a double bottom put in here. A couple of kahunas broke above the 50. This could have been my chart of the week as well, except Dan Fitzpatrick called it out, so I didn't want to copy him. But I do like this pattern as well, 2.1% dividend. Oil States International, again, another bounce off the bottom with pocket pivots. So each of these looks interesting. So if you don't have energy exposure, you might want one of the service stocks. Semiconductors. I'm not an Intel guy. Kind of looks like an oil stock, doesn't it? With V-shaped recovery, kahunas. Intel off the bottom, but some of these look better to me. Avgo, earnings are out, about to break above the 50. 2 kahunas, a pocket pivot out of a squeeze. AVGO looks attractive to me here. Great earnings per share growth still coming into the stock. Micron, don't love it. Mostly don't love its earnings growth slowing, and it's in a downtrend, so I'm going to skip by that one. Ambarella has earnings this week. Be careful. This was a super high flyer of the summer, and then you had a couple of bearish news reports come out to nail it twice. But it's inching its way back up, and we'll see how it does on earnings. They make the components for GoPro, and they also have a presence in the land of drones. This drop, much of this drop here was caused by concern about competition from Qualcomm. In this group, the other one I like to point out is Broadcom. Broadcom is being acquired, most likely by AVGO. You'd have to go and do your math, but I'd rather buy Avgo unless it's being discounted or it's being paid for more than you're going to get in the buyout. And the reason why I like it is it had a couple of kahunas. It's broken above the 50. It pays a small dividend. And, you know, obviously the price is somewhat protected because of a takeout. I suspect it behaves similar to to Avgo, just a cheaper way perhaps to play. But I'm not a hard-tested arbitrager, so you need to see which is a better play based upon the deal if it closes. Base metals, Freeport-McMoRan. This was a move related to, I think, Icon taking a stake. And, you know, looks again like the oil stocks, a V move off the bottom, huge downtrend, way below the 200-day moving average. makes money, although not a lot of money, small multiple, modest dividend. Is this ready? Getting an activist investor will make a stock move. Barron's came out and said they think it has a lot more to go. Candlestick on the weekly is a bullish engulfing pattern. Bingos are babies out with the bathwater. You can see the volume that came in this week, probably because of the icon story. Looks interesting if you want to play around with Carl. I like Alcoa, same exact looking chart. Again, long-term downtrend, makes money, pays a dividend, a couple of kahunas. This was a consideration for chart of the week. But again, it's hard for me to come up here and put a stock with this much of a downtrend and say it's going up now. Falling knives continue to fall. Tech is an ore play and coal play. TCK, a Canadian stock, it too showing some life. Kind of funny that it's back down here because I made a ton of money on this in 2009 when it was pointed out to me at a VectorVest meeting. And it was December or January, we were in the meeting, so the stock was about $5. And I bought it right before the market responded, and it went back up. I got out around 40, went even higher, up to 46 before it's gotten to this deep downtrend, back up to 50, almost 60. And we're back. We've done a round trip. We're back to $5. It's a real company. It's got a lot of assets. It's been hurt with everybody else with the downturn on the base metals. But if steel comes back, if coal comes back, Techminco probably comes back, pays a 3.4% dividend. It's one of these stocks that I don't think has much risk of going out of business. It can sell off assets if it has debt issues. Might be worth adding it to my buy list just because it is pretty darn cheap. I'm becoming a value guy after all. So a lot of beaten up stocks, oil exploration services and base metals. Biotech, not beaten up. These have had big runs, sold off hard. Is it time to go back? We'll go through the first bunch, and then I'll look at the IBB. Ariad, potential acquisition candidate by Bexalta, which was a spin out by Baxter. That drove it on Friday. This is one we've talked about in this venue many times. They've had trouble with their lead drug, which I think is a great drug. You could see it was once a $20 stock in 2012. I think everybody's expecting them to be sold. Their CEO was replaced with the expectation it will be sold. $10 seems like a pretty fair price considering that's higher than it's been since 2012. We'll see what happens. They do not make money. And again, I'm not an arbitrager, so I'm not playing that. I did get back into Celgene after our flash crash. I didn't get it at the bottom, but I got it in somewhere at the bottom, sort of down where my arrowhead is. Whenever you get a great asset, 20% off, you buy it. And I was sitting there, and I bought quite a few things on Monday. Nice little bounce. I think Celgene goes back to its old highs. I've always liked Celgene. I did sell out. I had 135 or 133. I can't remember what they were, puts. And I basically let them go back in the middle of August. Let my Celgene go, but I wanted to get back in. I use this as an opportunity to get back in at a deep discount, like my discounts. Insight, mostly a preclinical company. They do have some marketed products, but they don't make money. Kind of a lower left, upper right. Looks like it wants to break out again. They've got some great assets. Don't know what's causing this. Out of a squeeze, multiple kahunas. If you got it, God bless you. I should have been trying to buy this one on the pullback on Monday. Gilead pulled back into the 80s on Monday, back up above 105, which is where the 200-day moving average is. Still like this stock long term. It's not doing anything. Biogen, this is kind of what precipitated the IBB rolling over when it missed earnings, going sideways. Not a good, exciting story right now. Amgen got approval of a new cholesterol drug. It'll be interesting to see what happens. Not much in the way of earnings growth. Pays a 2% dividend. Amgen's kind of like a big drug company now, no more a sexy biotech. One of the charts that actually looked good to me was this one from Medicine Company. It's a little bit loose, but 3 kahunas in a row, everything's green, out of a squeeze, doesn't make money, breaking out above the 50, PSAR reversal. This is a beautiful chart except for the looseness. If I just look at this breakout, I'm quite excited and quite interested, and I'm going to be doing some more research on Medicine Company. Anything down here that came up on my analysis? Regeneron, if you're a long-termer, every time it hits the 50-day moving average has been a good buying opportunity. It's sitting right below the 50-day moving average right now. You might want to consider buying it if it breaks above. Biotech, let's look at the IBB. Looks kind of like energy with the pullback here, except it's been in a long-term uptrend. IBB is sold off hard, no question about it. From its spinning top high to the Monday low, it dropped almost 30%. So that means if you've been holding Celgene and Gilead and Biogen Idact and Alexion, you've been getting fairly hosed. It's bounced. I bet it goes back to threaten highs. As somebody else said, and I've said before, biotech has unlimited pricing power in this country. Whether that's good or bad, I'll leave that to the experts. Who cares what the economy is? Healthcare is going to hum. They can price whatever they want. I think biotech goes back to highs. I'd be looking to acquire more biotech like I did in Celgene at the discounted prices. Integrated oils. They do a little everything: refining, marketing, exploration, and they have gas stations. I bought some ExxonMobil on this pullback. Why did I pick ExxonMobil? I could have picked Chevron, 5.3% dividend, bouncing off the bottom. ExxonMobil, 3.9% dividend, bouncing off the bottom. I picked Exxon because there's been a lot more talk, or ExxonMobil rather, of it being a potential acquisition candidate. They've had to no pun intended. They'd have to eliminate a bunch of assets related to, BP is the one that's a takeout candidate. My mistake. ExxonMobil, I bought because I like the asset. I think it's equal to Chevron. BP is a potential buyout candidate. Same exact pattern. Pays a 7.2% dividend. Maybe I should have been nibbling down there. Pick your integrated oil. So I think if you don't have energy exposure, obviously we want to see what oil does this week. But if you're not in oil, 3 ways to play it, and maybe one of each: exploration and production, services, and integrated. Specialty pharma kind of runs closely to biotech. One of my biggest holdings is Valiant. And this is one I manage with puts. When it gets toppy, like it did here on a weekly chart, it is not unusual for me to look at buying puts at in the money, selling calls, and selling puts way out of the money, perhaps down at a natural support area. This way I can manage my stomach, and even if the market pulls back to 220, 208, my net asset becomes the same because my put goes up in value. It's kind of like life insurance, health insurance, car insurance. You're in no hurry to use the insurance, but you have it in case of a catastrophe. And maybe I'll do a talk one day on how I use married puts to reduce the volatility of my portfolio. Valiant looks like it wants to go higher. It's a great asset. It's got great earnings. It trades at a discount to its growth rate. No dividend. At some point, they'll run out of things to acquire, or they'll have some hiccups after an acquisition. As of now, they've done very well. Mallinckrodt bought Questcor, pretty deep pullback. This was a potential short up here. I think I even brought it up last week. Bingo. I like to see some momentum and some kahunas coming in. Don't see that right now. Shire looking to make acquisitions. This is when it was trying to be acquired, I think, by AbbVie or whoever was looking at acquiring it, which fell through. kind of at the same level. Did have a kahuna on Friday. I think they started looking at an acquisition. I can't remember who. Here's that tetraphase. Here's my uptrend. Pullback. Big topping tail. These are weekly. Let me get out of the weekly charts. My bad. Big topping tail. Here's support on the 200. My concerns about this one is it's got to get through the 50. If it gets through the 50, I'll look for it to take out the old high, which is why my target's about 52. It had a pocket pivot and a kahuna on Friday and a mobile breakout out of a squeeze. I like this chart a lot. That's why I chose it. And again, for those that question whether it's in an uptrend, it's in a huge uptrend when you stand out and look at the weekly. Next group down, application software. Let's see. Activision must have had earnings on Friday. Bible gap up on huge volume and a pocket pivot. So I right click, more info from web. Let's go to FinViz, and FinViz says, nope, it's joining the S&P 500. Even better than earnings, although United went up as well. Whenever I own stocks that get added to the S&P, they don't go up this much. So they had a big move by being added to the S&P 500. Viva, still in the penalty box, well below 200, although did have pocket pivots and a kahuna. Has got good earnings out, but still pays at a big PE. Salesforce, I don't see anything here that gets me that excited. Renewable energy, Sun Edison, this is just a bounce after getting hammered. Hammered with a little bit of a bounce. They have a acquisition, Solar City. Hard for me to be excited by this either. I think Sun Edison is supposed to buy Vivint. And I think this was the takeout day, and it's already back down to the pre-takeout price. There's a lot of question about whether that deal will occur. I don't think there's anything too exciting in that group. Communications equipment. Let's take a look at Apple and see what we think there, and let's go look at some seasonality on it as well. So Apple, I got into on this day in the lower part of the chart with one of those orders that I had stuck out there just in case. So I'm up about 20 bucks on that trade alone, maybe 16 bucks on that trade alone, 17 bucks on that trade alone. And then the issue is, what do I do with it now? On a lot of these stocks, let's just look at the weekly. On the weekly, it almost pulled back to the 200. I can't tell you how many stocks pull back to their 50 intraday or to their 200 intraday and bounced on Monday. Apple's in a difficult time in what is typically a seasonal strong period. I'll probably take some profits, to be honest with you, at this point. Small dividend. It's got a big meeting on September 9th where they're going to introduce us to the next iPhone. But I might go look at some seasonality. So let's look at seasonality at Apple, which I know for a fact is strong. So under normal circumstances, between September 8th and October 19th, it's been up 8 out of 10 years for an average return of 10.1%. On the 2 years it was down, the average return loss was only 3.9%. From November 16th to January 6th, it's been up 8 out of 10 years for 8.8%. So we're going into a very strong time of the year for Apple. The challenge for me is that it's been in a downtrend. So why all of a sudden would a stock that's been in a downtrend change just because of seasonality? I'm a believer that technicals trump seasonality. I have my doubts about Apple right now, but I am going to leave a small position on to see if that seasonality kicks in. Well, that's the top 10. Let's take a look at some of my favorite stocks, and we'll jump into TradeStation and look at some of the ones that I thought were most attractive and look at how I apply person stuff to the stocks that I find in HGSI. This was a list of some of my favorite stocks for the week. And then I did some additional filtering, so let's take a look at some of them. ACTG, Acacia Research. This is a high dividend payer asset manager that has fallen from a high of around 20 down to the 8 and 9 level. So it's been crushed. It's moved up off the bottom, going sideways, and I spotted it because it had a person buy signal earlier in the week, and it looked like it had bottomed to me, and I actually took a position in this, I think, on Wednesday. So Acacia Research, it's not for everybody, and probably what's driving it for me was the high dividend. I've done very well with BX, which is another one of these asset managers, and it just looked to me like it's put in a bottom down here. It had a kahuna out of a squeeze, great earnings per share growth coming into the stock. It's a turnaround play, and it pays a dividend of 5.3%. I mentioned Alcoa. We looked at it before. Not only does it in a downtrend, but it had a person's buy signal on Thursday in a high closed doji. And then you could see my dots are all turning green. And in my world, green is good and red is bad. So that's a very good signal here. It tells me the weekly bongo here is green. The monthly and the weekly bongos are still, the daily bongos green, the others are still red. So this is bottom fishing. I have a hard time putting bottom fishing on as my chart of the week. ARLP, this is one of those coal plays I was referring to with a big dividend. Kind of flatlining here at a price tag of about $24. Couple of kahunas this week. Everything's turning green. Had a mobile breakout out of a squeeze. Pays a dividend of 10.7%. That was enough to intrigue me, and it had person buy and sell buy signals on both the weekly and the daily. OBV to new highs. Usually volume leads price. My indicators turning green. ARLP. We looked at AVGO, which was right below the 50. You could see it's in a person buy signal as well. And Broadcom, which was the cheaper way of playing it, also in a similar buy signal. On the weekly on Broadcom, a high closed doji and a buy signal on Friday. CEMP is another biotech stock with a high closed doji on Friday, breaking out volume. Thought that was an interesting look. COTY, this was another stock that I struggled with as my chart of the week, and maybe this would have been a good pick. This is probably clearer in an uptrend, although loose. Pull back to the 50, has a kahuna, mobile breakout from a squeeze, diminishing growth on earnings, pays a small dividend, and on Thursday had a person buy, also in a person buy weekly. CCRN, think Molina Health. This is another managed Medicare, Medicaid player. CCRN had a buy signal on Friday. Great on-balance volume. Let's just take a look at it in a more traditional chart. Actually, I think they might not be insurance. They're staffing. They're not insurance. They're staffing. But if you look at this on a weekly chart, I've been watching this for a while. Nice uptrend off of the 6 level. A little bit of a bull flag here on the weekly. On the daily, married to that 17-day moving average. And as I showed you on person buy signal on the daily. I mentioned Diamond Offshore. Again, it had a buy signal weekly this week. And then on Thursday, certainly a beaten up dividend payer in the drilling. ERI. What is ERI? Is that ERI is Eldorado Resort, so this is gaming. Saw a lot of chatting around that in some boards. Nice uptrend. PSA reversal closed, mobile breakout from a squeeze. Again, this could have been a buy pick as well. Break above that PSAR dot might be interesting. And it did have a person buy signal. FTIs at FCN Consulting, high close doji on the weekly, daily high close doji on Thursday, and a buy signal. Volume is moving up on the daily. Again, off the bottom, an oil stock. Inogen is a medical supply stock. It pulled back after earnings a little bit. Looks like it wants to run again with a new daily buy signal, OBV to new highs on the daily. MDCA is a builder, I believe, on a new buy signal on weekly and daily. Green forming on with my indicators. NOG, another beaten down oil exploration stock, had a buy signal on Wednesday. Weekly buy signal. You want to see what beaten down oil stock looks like. I suspect this is a shale play, and you can see it moved above the 50. Now, from a health-wise perspective, the fact that it's broke above the 50 makes it different than a lot of the other players. Did have a multiple kahunas, everything's green here. That might be an interesting thing to take a look at. Oil States International, another of the oil services names, on a buy signal both weekly and daily. SPWH, Sportsman's Warehouse, on a weekly buy. My signal's all firing green. Nice move on Friday. Another one I liked a lot. Kind of an interesting, not really a cup, more of like a box. Breaking out here with the Bible gap up on Friday. And I think that must have been on earnings. Let's see. Unless they got added to the S&P mid caps. Let's see. Nope, earnings. Assume it was earnings. Tetraphase, that's the one that I like so much as my buy of the week. Notice the green here, the yellow means it's in a squeeze. Volume breaking out to new high in a daily buy. And then here's that medicine company that I was intrigued by as well. So futures are minus 139 fair value on the Dow, minus 18 on the S&P, minus 34 on the NASDAQ, minus 8 on the Russell. It's still early. I don't know if Greece is open. Let's take a quick look before I say goodbye. I guess not Greece, rather China. Not seeing anything in China yet. So I suspect the futures will be up and down a few times before we open. So in summary, last week was a special week. We won't see, that's a special girl, that's my wife. We won't see a lot of weeks like last week. What an opportunity on Monday to buy things at a deep discount. One of the other things that I bought was Netflix. And, it's funny, a lot of times on TV, they just say, they won't let you in, they won't let you in, they won't let you in. And, this is one of those stocks that it's pretty hard to buy it up here at 130. But you could have bought Netflix if you were lucky, anywhere between 85 and 100. And I got in somewhere in that range and took a pretty nice sized position. Actually, I went crazy. I sold puts at 80, I think $80 or $85 puts at the same time as I was buying the calls, because if somebody wants to give me Netflix at $80 a share, minus what premium I got for selling the puts, I'd probably be happy to take it as well. So it was an interesting, crazy market. Thanks to John for teaching us how to throw some offers into the market before it opens, because Thinkorswim just did not work for me. Last comment, just to that whether you use HGSI or not, we have started a group called the PUG Group. To be in the PUG Group, it requires the use of HGSI or TradeStation with John's lifetime package. I was able to negotiate a very good price in a combined deal between John's indicators and HGSI. Special offer on TradeStation, and I've thrown my indicator package in at no charge. The group's getting to be of good size. John spent a lot of time with the group, and it's really about making us better traders. It's a chance to expose John and some of his users to HGSI, and to expose some of the HGSI users to what I do with John's stuff. Anybody is interested in this, and on the HGSI part, it's pretty much the deal is for new users. The trade station is the lifetime package, so it would pretty much have to be a new user, because if you already got it, you don't need to buy it again. So if you have any interest in those or any questions for me, my email is hgsidoc@gmail.com. Trade safe. Make sure you live to fight another day. Tough market out there. Don't feel down if it gets you, because this is the toughest I've ever seen it. You all have a great day. Goodbye, everybody.